While most people are focused on the stock market, the S&P 500 or the NASDAQ, looking at the charts, waiting to see when they may start to crack, when things might start melting down, the reality is they're probably looking at the wrong thing. 30-year traders that have spent time in the pit know that the stocks are really the tail of the dog that's being wagged by the bond market. Today, I'm joined with a 30-year bond trader who explains the risk that's in the market today, how to quantify it, how to trade against that risk. We're going to look at different things. We're going to talk about what's going on in China with Evergrande and the risk that it's putting onto the rest of the system. We're going to talk about other ways that we can protect ourselves, how we quantify that risk. Now, we are joined by my good friend, Greg Foss. He's back for a second time, and he's also going to be taking part of the live event that I'm hosting in a couple of months in Miami, and its theme is the Great Reset, surviving the Great Reset. You know that these times are troubling, and the world we're going into is not the world we're leaving behind. And if you want to know what to expect over the next year or two, and more importantly, how you need to be positioned to protect your wealth, build your wealth, and protect your privacy and freedom, then come hang out with me live and 15 of my friends as we explain what we see happening over the next year or two. More importantly, what you need to be doing to survive over the next couple of years and have options of things that you can do, actual service providers on site if you want to take advantage of that. We're going to jump into it with Greg Foss, my good friend. We're going to talk about this stuff. And like I said, come hang out with us live. There's a link down below if you want to check out that live event. And let's jump right into it. Hey everyone, welcome to another episode of the Market Disruptor Show. And today I am joined for a second time from my good buddy Greg Foss. You might have remembered the Foss brothers, the Foss and Moss brothers show. We are bringing it back one more time. Greg, I'm so excited to have you back. Thanks for joining.
It's my pleasure. It's great to see you. We had a pretty good riff on Ben Sessions' BTC Sessions show on Friday night. So this past Friday. So looking forward to talking.
Yeah, that was fun. And he does such a good job of bringing people together and really getting the energy up. And you definitely bring the energy. So I love that. I know, as I said, you're back for a second time. And of course, we've talked offline and whatnot. And I know you kind of had this career being this bond trader. And so you kind of approach the markets from a little bit of a different angle than I talk about and most people talk about because of that bond side. And of course, so I know who you are. But just give us a little bit of background on kind of what your career has been and what you're doing right now.
Sure. Well, thanks for having me. I very simply am an old guy, 58 years old. I graduated McGill Engineering in Montreal in 1986. And so engineering is at the core of my risk analysis, if you will. Why? Because risk analysis is all mathematics. Isn't it great that Bitcoin is math plus code? So I have a grounding on that side. But I graduated engineering in 1986, went to school in the US 2 years later at a business school, Cornell University. I was lucky to get in. I would not have gotten in if I was an American. The reason I got in is because they were building an international business school. And I wouldn't have got in. My marks were good enough, but I didn't have the work experience. I got in because I was coming from another country. They were building up their international business school. So everything happens for a reason. Got to experience the difference between the different cultures, Canada and the US between 1986 and 1988. And great time, beautiful campus, beautiful Americans. I love that country. And in 1988, though, I returned back to Canada and I started working for Canada's largest financial institution, the Royal Bank of Canada. And I have experienced my share of credit crises throughout my career. 1988, I was thrown into the fire because the global financial system was under pressure from Latin American debt. It was called the LDC crisis, lesser developed country crisis. But really, it was driven by Latin American countries like Mexico and Brazil, Argentina, that had all defaulted on their obligations to money center banks globally. Royal Bank of Canada, Canada's largest financial institution, was no different. And I was put in charge of pricing it doesn't sound like a lot of money, but at the time it was over $1 billion of exposure to Mexico. And I had to come up with a solution, not a solution, but I had to choose a restructuring option that was being proposed by Treasury Secretary Nicholas Brady.
Hey, hold up just for a second. I want to tell you about something. I just got something cool in the mail I want to show you, and it is this new sleek package I just got with a brand new credit card. This isn't just any credit card. This is a BlockFi credit card that's powered by Visa, and it's backed by Bitcoin rewards. So this is a Visa card. I can use it anywhere in the world that Visa is accepted, and the benefit of this BlockFi Visa card is that I get paid back in Bitcoin. Most of my other cards pay me in some sort of reward points. I get airline miles. I'm not very good at using those. They end up accumulating and I don't do anything with them. But getting to earn Bitcoin back with every single purchase is of course something that matters to me. Now, I know for a lot of people, they say that the price of Bitcoin is too high. So I say, well, you can always earn Bitcoin. You can get paid in Bitcoin, or you can just get cash back rewards on every purchase paid in Bitcoin with the BlockFi Visa credit card, used everywhere that Visa is accepted. And if you want to sign up for the Visa card that pays back in Bitcoin from BlockFi, there is a link in the description down below. Check it out.
Royal Bank of Canada wasn't the only one in this boat, so we're all money center banks, as I mentioned, globally. But that was my first eye-opening experience. Essentially, I'll jump right to the conclusion that I realized that the fiat banking system is a Ponzi. Okay. 1988, I come right out of school and I realized that the fiat banking system is a Ponzi. And so I lived through 1988 when the global financial banking system was insolvent. I don't have to go through the mathematics for you. Just trust me. 1988, eye-opening experience. I went to my CFO and I said, Emil, we have a big problem. And his answer was so beautiful. He goes, I know, don't tell anybody. And I'm like,
nobody will find out.
What? Well, no, because the bank analysts at the time, the equity bank analysts were too stupid to do the right mathematics to figure out that the system was actually insolvent on its way to bankruptcy. But Treasury Secretary Nicholas Brady knew what was going on, so he rescued it. That was my first restructuring. 10 years later, I lived through the long-term capital management restructuring. I was a trader in high yield credit on the street in Canada, traded mostly with US accounts and with Wall Street. But then in, I guess it was 2003 or so, I switched sides of the street and I went to the hedge fund and I became a trader at a credit fund. A credit hedge fund. So from 2003 through to 2014, I worked at two separate hedge funds, but I lived the global financial crisis. That was really scary. 2007, 2008, 2009. I sincerely thought that the world was going to end. This fiat Ponzi, the gig was up. But once again, the Fed printed money, rescued the financial system by printing money, taking essentially the risk of the financial system and transferring it to the balance sheets of the Fed and the governments. And the system was rescued again in 2009. So I'd lived up to that point, 3 different global financial crises.
And is each one getting bigger and bigger?
Oh, yeah. Well, it's not just getting bigger, Mark. Some things that happen is the risk that's transferred to the government balance sheets. They have a chance to pay it back down, but they don't, because no politician that's in the markets, that's in office is going to be austere and say, okay, it's time for us to pay all this debt back down, because they're never going to get reelected, right? Yeah. So the debt just continues to build and build and build. And between 2009 and 2019, COVID, I guess 2020, that 10-year period, there was a chance to do the right thing, which was to pay down the debts. But you will recall that every time the Fed tried to taper, the equity markets absolutely had a panic attack, right? And anyway, then we hit COVID, and now, unfortunately, it is too late. There is no way to get out of this. Mathematically impossible to escape the debt spiral. It will turn into a death spiral. I don't want that to happen, but math doesn't lie. It is mathematically impossible to escape the global debt spiral, because it is impossible for the global economy just to grow fast enough to pay not only the accruing deficits, but also just the interest coupon on the debt. They cannot even service the debt with the growth of the GDP or the global financial, the global economy. So
Yeah.
math doesn't lie. I had been looking for a solution to the to the Fiat Ponzi since 1988. I didn't really become a gold bug. I appreciated what gold offered, but I didn't like go all in on gold. But then in 2016, after I had retired from the hedge fund community, after 30 years of managing money and risk, someone introduced me to Bitcoin. And my first instinct was, like everyone's, yeah, I've heard about it. It's got to be a Ponzi. And then though, I'm an engineer. The one thing that the gentleman who introduced me to it showed me was tradeblock.com. Essentially, it's the blockchain in action, where you're seeing the different block heights, you're seeing the last miner, you're seeing the fees, you're seeing the hashes, you're seeing the transactions across the world globally and being put into blocks. And I'm visual. And I looked at this, Mark, and I'm like, what? Get out. And then I'm excited because I see $25 cross, and then I see $450 cross. Then I see $5 million cross. Yeah. And I'm like, what? This is impossible. This is a thing of absolute beauty. And you're telling me no one controls it. It's decentralized. And I'm like, I found the solution. Yeah. After searching for close to 30 years, I found the solution to the Fiat Ponzi, and it's Bitcoin. And I sort of fell down that rabbit hole, and I'm supposed to be retired, but I'm not. And I'm happy I'm not, because I joined up with a really cool energy group in Canada called Validus Power that is doing some cool stuff with Bitcoin miners all around the world, focused on North America. And, Bitcoin mining is, or Bitcoin miners are the marginal consumers of power, electricity around the world. So Bitcoin miners, the energy markets need to understand Bitcoin miners. Bitcoin miners need to understand the energy markets, and Validus Power is at a perfect intersection between the two.
Great, man. That's so many areas I want to dive into there.
Okay.
For everybody listening, one of the most requested topics that we discuss is what's going on with the Evergrande situation in China. I want to dig into that. I want to ask you about something you and I were talking about offline that maybe triggered this conversation, which was the CDS on the credit default swaps in El Salvador.
Okay.
Remember I sent you that chart?
Yes, absolutely. Yep.
So I want to talk about those couple of things. So stay tuned. But before we do that, you just said something that, for all this time you spent as a bond trader, and then a hedge fund game. And since the 80s, you were looking for a solution to the Ponzi scheme. You were unable to the Fiat Ponzi scheme. You're unable to find that. And then finally, when you found Bitcoin, you finally found the solution to the Fiat Ponzi scheme. So what is that? Why is it the only solution you're able to find in 30 years?
So
how exactly does it solve the Fiat Ponzi?
Great question. So let's define why I think it's a Fiat Ponzi scheme. So capitalism is built on credit, and credit, which is leverage, essentially becomes levered in itself, because the global banking system, people don't understand this, that for every $100 of loans that a bank makes, and this is any bank globally, for every $100 of loans that bank makes, they actually only hold between $4 and $6 of risk absorbing equity capital. The other 94 cents, or 94% rather, 94 to 96% of the funds that go into that loan are deposits, whether they're retail deposits or interbank deposits or a bit of subordinate bank debt. The reality is the only thing there that is put within that funding source is really the equity capital. The deposits have some deposit insurance on them. The subordinate debt is a contractual obligation. It's not like you can default on that contractual obligation and there's no repercussions, but the equity is there for the risk absorbing capital, for the losses that are a fact of life in banking, right? You don't want to lose the money, but the reality is borrowers default, and that default comes out of the equity capital of the bank. Now, the reality is, if the banking system is 25 times levered, meaning, again, there's only 4 cents of equity capital for each dollar of loan, that means it's 25 times levered. My God, that is an incredible amount of leverage that people don't understand. They figure, oh, don't worry, the bank is too big to fail. And there's an implied backstop by federal governments, right? Certainly in Canada, everyone thinks, oh my God, the Royal Bank of Canada is too big to fail. The government will certainly bail it out. And by and large, that's true. And we've seen these actions take place on Wall Street time and again. Long-term capital management. Can you believe that long-term capital management was actually over 95 times levered? 95 times leverage they were using in this structure, and everything was fine because they had 2 Nobel Prize winners working there. What a crock, right?
Yeah.
So the reality is, okay, so this is the fiat system. It exists like this. And there's an implied backstop by the government. Well, how would the government backstop a bank failure? We all know. They print more money, right?
Yeah.
So therein is the fiat Ponzi. In my very, my very first job, my very first exposure to this. And by the way, they never teach you this in school. They just say, well, yeah, banks are levered 25 times and everything's fine, because that's the way it's always been. So, I defined it as the fiat Ponzi in hindsight, like not at the time. I'm like, this really smells. Well, what am I going to do? I'm a young kid. I'm going to go out and rewrite the rules of global banking.
Yeah.
The Bank for International Settlements at the time came out with new capital guidelines that were supposed to make banking less risky. It's sort of like saying, yeah, this atom bomb is less risky because we've turned it into a hydrogen bomb, for example. I don't really know if that analogy applies, but the point being, look, it's an explosive product. Nobody really understands the true risk of it. And the government says, it's all good. We will cover any explosions because it's too big to fail. And I'm like, okay, if that's the way it works, that's the way it works. The problem, though, as we've seen with each successive financial crisis, is that leverage does get transferred to the balance sheets of the government. And you and I are citizens of countries that owe this debt to somebody.
Right.
And that's not a great thing. And this money printing has cost, in my opinion, our kids their future.
A lot of people would say that, well, we just owe the money to ourselves, or
no, that's not how it works.
Right. Or they would say, oh, we just owe it to the Fed, which printed it out of thin air. So what if we default on it?
Fair enough. But that being said, I always looked. So there is this market, and you made mention of it, a market called the credit default swap market. Okay. And that's basically a market for insurance on any counterparty. It was the market that foretold the imminent downfall of Bear Stearns and Lehman Brothers, for example. It's a very sophisticated, institutionally traded market that basically judges the relative likelihood of failure for anything, whether it's a corporate, whether it's a mortgage bond, whether it's a structured product, or very interestingly, whether it's a country. So within that market, you can get relative levels of default probabilities amongst various countries around the world. And, the United States is a very high quality credit. But the fact that the insurance on the United States trades for anything above zero, meaning there's people that will pay a premium to get insured on default of the United States, means that it can't possibly be truly risk-free, right? Isn't that fair? So it's a very, very, very minuscule risk, but it's not zero. And that risk is going to change over time as the amount of debt outstanding to, you call it ourselves, we owe it to ourselves. There's some people that look at that and say, dude, you can owe it to yourself, but I don't want to owe it to myself, so I'm going to purchase insurance on that. Do you know what I mean?
Yeah, and it's not just that. I mean, we owe it to the Fed, which printed out of thin air. So
but then they print, and then fiat becomes less valuable because there's more fiat for the same amount of assets, right?
But there's a lot of retirement accounts and pension funds and stuff in there, and so you
don't need to tell me. I mean,
Yeah. If the Fed doesn't get their money back, that's one thing. But like the owe it to ourselves. Well, if you're trying to retire and your pension fund goes up in smoke, then
That's not so good, is it? And that's the reality. You nailed it right there. Like there's so many pension funds right now. So I spent my life basically trading bonds for 30 years. I can categorically tell any of your listeners that if you have any exposure to bonds, you're a knucklehead. Okay. Right now, bonds are a return-free risk. Think about that. It's a brilliant statement. They are return-free risk. They're not risk-free return. They are return-free risk. Okay. And the 10-year US Treasury is set as a function of inflation expectations, but there's also a very important component that is a credit consideration, which means an important component of the 1.3% 10-year US Treasury is a little bit that rewards people for taking the credit risk of lending to the US Treasury. And you may say, oh, Foss, you're off your rocker. And I'll say, okay, well, then look at a country that does default on a regular basis. You brought up El Salvador. Let's not talk about them. Let's talk about a serial defaulter.
Let's talk about where I'm here in Puerto Rico.
Okay.
They defaulted on their
absolutely.
bonds.
100%. I don't know where the Puerto Rican spreads are right now, but I will tell you that within my life, Argentina has defaulted 4 times.
Yeah.
Like this is real risk. And you can say, oh, the United States this, the United States that. I will just say good. There's 165 or more other fiat issuing borrowers, sovereign borrowers out there. Don't tell me there's no risk in sovereign credit, because I've seen it. I started my career when Brazil, Mexico, Argentina, Venezuela, but Philippines, Vietnam were all in default.
Yeah.
Now these Go ahead.
Let's try to, I'm going to try to explain this out a little bit for the listeners who maybe aren't fully up to speed on what we're talking about here. But basically, governments need debt. They issue bonds. So that's like the note against the debt.
Yes.
And you could buy that debt in different lengths, 5 years, 10 years, 20 years, et cetera. And so when I buy that bond, I'm basically loaning money. I'm giving my money up to the government. I'm loaning to them. And in exchange, they're going to pay me a rate of return, just like any other loan. Beautiful. And that might be 1.5%, 2.5%, depending on what the length is.
Yes.
Now, typically that's considered a risk-free return because the United States would never default on the debt, right? And that's why it's risk-free. However, what you're saying is it's a return-free risk because you're getting whatever 0.5% or 1%, correct, basically no return at all, but you still have the risk.
So absolutely. Here's the reality. When I started trading in 1980, I started trading my personal account before I started trading professionally. When I started trading professionally in 1988, 10-year US Treasury rates were double digit. And when I started trading my personal account, 10-year US Treasury rates were 18%. Wow. 18. Okay. Now that was mostly due to Paul Volcker and battling the inflation boogeyman. But over time, the leverage at the US government has increased so much that people have to understand that there is a very small component of credit risk in there. But let me try and simplify this. Imagine if you lived in Argentina and there's the same sort of government borrowing curve. Don't you think that curve accounts for a lot of, I don't care about inflation as much as these guys have failed to pay me back 4 times in the last 20 years. Don't you think there's a component of credit risk or an interest component that's priced in there as a spread that accounts for that default risk? And I'll tell you categorically, 100% there is, okay? And the market decides over time how much that spread should be. The higher the spread means the higher the expectation that the issuer will default and that the lender or the bond buyer needs to be compensated for that, right? Who in their right mind would give money to a serial defaulter at a rate of, let's say, 1% or 1.3%, which is the US Treasury rate, when you're lending to Argentina and you have to remove currency consideration? So you're lending to Argentina in US dollars. So you're comparing a US dollar obligation in the US to a US dollar obligation for Argentina. Somebody in the 10-year term is going to say, Argentina better pay me 8% versus the US paying me 1.3% in order to compensate me for the default risk over that period, right?
Yeah. And then there's still another form of default too. So for example, in the case of some of these nations going bankrupt, like Puerto Rico too, they renegotiate with the bondholders to potentially accept less than they're owed. So there's one type of default. But the other default is where this is probably where the United States is considered risk-free, is because they'll probably never do that. Well, at least 9 times soon, because they'll just print the money. But that technically is also maybe a default.
It is a great
now
way
they're
to describe
giving you, even though they're giving you back the full 100% of the money you gave them, it's only worth half the amount.
Beautiful. I can't say it any other better. A bond is a fiat program, a fiat contract, right? Because that's all it is. A bond is a contract. You are contractually obligated to pay a certain interest expense or a coupon over a period of the bond. And at the end of, let's say, 10 years, you get your $100 back. You lend them $100 at time zero. If there's a coupon on it, it's paid semi-annually. And after 10 years and 20 coupon payments, the contract has not rolled over, but expired. And then more debt is issued. Now, the cool thing that you always keep bringing up is you're right about the United States. But think of all the other countries out there that have the same type of contracts outstanding, which regularly don't fulfill the contract. And the United States will be the last fiat country to default on their debt. But think of the Venezuelan situation. They have the ability to print, but that money just ended up on the curb, right? Because people said, it's garbage. It's worth nothing. So you gave me the $100. You're most likely going to get your $100 back. But you mentioned it, the purchasing power of that $100 is going to be vastly reduced. So it is a mug's game. For that reason, I say I have never seen worse value in the bond market. And that includes high yield bonds. It includes mortgage bonds. It includes provincial or state bonds in the US, and it includes US treasuries. I've never seen worse value in the fixed income markets in my 32 years. And therefore, if you own bonds, you are in a losing fiat contract. You're not being properly compensated for your risks in absence of the fiat destruction that's taking place at the same time.
Yeah. So with what you just said there, which is, the U.S. will probably be the last one to default on their bonds. Let's jump to another country then. And so I think now is probably a good time to jump into this Evergrande situation.
Okay.
And so, one thing that we saw in 2008, and I'm sure over your long career, you've seen the study path of this, but we saw in 2008 where the entire financial system was basically kind of connected. And so the United States took a hit with the banks, and then the whole kind of financial system went down. One, I would guess, and you can tell me, I would guess that that's probably only gotten bigger and worse, meaning that we're probably more interconnected maybe than we were in 2008. And then if so, then this Evergrande situation in China. So this was the largest public company in China, largest real estate company. Basically, they're going broke. They can't afford to pay their bondholders. They can't pay the interest on their debts. And it's crashing the markets in China. But how contagious is that for the rest of the world?
Yeah, so you never know. In hindsight, it seems so obvious, right? In 2007, do you remember the famous rant by Jim Cramer? It was on a warm summer day, and he was being interviewed, as he always does, on CNBC by this lady, Erin something. I've forgotten what her name is, but she was a sweet thing and Cramer gets on there in an August afternoon, and the equity markets were under pressure. And the reason the equity markets were under pressure is because the credit system was gurgling. I like to say the credit system was gurgling. Okay. The credit system is not transparent like the equity markets. Equity markets trade on an exchange. Most bonds trade what's called over the counter amongst sophisticated financial institutions and buyers and sellers. So the typical retail guy, mom and pop, does not really understand how the credit markets work. But what they were able to see was that the equity markets were getting really under pressure. And the reality is, why do equity markets get under pressure as a result of credit? Well, Mark, you and everyone who's taken Finance 101 knows that the credit markets, firstly, are far bigger than the equity markets. But most importantly, the credit markets have a priority of claim over the equity market.
Equity,
So
right.
in a company that issues both public bonds and public equity, unless the bonds, in the event of default, unless the bonds are worth 100 cents on the dollar, the equity is worth zero. Now, there could be a what's called a cram down and a restructuring where the equity actually does get a little bit of value. But the truth is, when bonds trade at levels that reflect distress, the equity gets just decimated. Why? Well, I worked at a hedge fund where I would take positions in distressed bonds. And how could I hedge that position? I could short the equity, right?
Right.
Well, when the equity is getting shorted and mom and pop have no idea what the heck is happening, and even the foolish equity analysts who work for Wall Street, who have buy recommendations on the stock without even considering where the bonds are trading, these guys are fools. But I always say credit is the dog and equity is the tail. Right. And that tail can get flung around like a rag doll when the when the credit markets are not happy. Okay.
Let me try and see if I can summarize this for everybody that's trying to follow along here. So basically, when a company could have obviously their equity, which is their stock.
Correct.
So when you buy the stock, you have equity, you have ownership in the company, but the company also has debt, most likely, and that's in the bonds. And in some sort of a situation where the company got into trouble, and they had to consolidate or they had to liquidate, the company would be obligated to pay the debt, to pay the bonds first.
Correct.
And then if there's any money left over at the end, after all the debt's settled, then the equity holders will get money. And so basically what you're saying is if the company couldn't liquidate and cover all the bonds, then there's no money left going to the equity holders.
I'm saying exactly that. And you know, what we've done successfully is siloed our markets so that people try and think of, equity as being different from debt. But sometimes the best way to simplify it is think of debt as being senior equity, or the flip side is think of equity as being junior debt. Okay. Unless the senior claim is fully paid, the junior claim has no value.
It's like a piece of real estate. You have a first trustee mortgage, and you have a second trustee mortgage.
Yeah. It's very simple, guys. Don't overthink it. But people, again, you need to understand, if you were to invest in what's called the enterprise value of a company, don't you think you should probably look at where the senior claim in the capital structure is trading before you take a punt on the equity? Or even if you write options or purchase options on the equity itself? I'll tell you, as a hedge fund guy that traded in the credit markets, I would love when there was stupid money in the equity markets bidding up the price of the equity when the bonds were signaling that there was distress in the company. I'm just like, sold to you, man. You can take this equity because it is now an option. I'm not saying you're going to lose your money, but if you do make some money, I guarantee that my money is going to return to parity or 100 cents on the dollar.
Right. And so I think that's the problem with the Evergrande situation in China, is they have about $300 billion worth of debt that they can't afford to pay.
Yeah.
And since they can't afford to pay the debt,
don't even look at the equity right now, Mark, because everyone still does. The equity is now an option, and that option is essentially worthless. It's got some time value, but there is no claim. There's no asset value in that equity option. Okay. It may be an option that the CCP is going to come in and do some sort of restructuring that provides the equity guys with some sort of recovery. But the bonds are trading at under 30 cents on the dollar. Okay. Wow. You don't even calculate what a yield is at that point because the yields don't make sense. It's trading at 30 cents on the dollar. Why? Because the guys that are actually buying it now are calculating a return where they can buy it, where they think a restructuring would occur, and they'll make their appropriate 20%, let's say. So let's say they think the recovery value on the bonds, and let's not talk about how long it'll take for that restructuring to take place, is 40 cents on the dollar. Well, if you buy something at 30 cents on the dollar and you get a 40-cent recovery, you're making 33%, aren't you? It's $10 on $30. That's 33%. Well, that's a pretty juicy return, but it doesn't mean that that bond, which is trading at 40 cents on the dollar, ever goes back to 100 cents on the dollar.
Right.
Now, what does that mean about the equity? It means that the equity guys, they're still hoping. You guys are stupid. If you're going to put more money into this enterprise or this capital structure, you may as well buy the bonds.
Right.
not the equity.
Which is why the equity is plummeted off of a cliff.
Okay, the fact that it trades above zero indicates still how much stupid money there is in the world.
Or people think, just like the bond, that if there is some recovery, that maybe the stock can go back up as well.
Mark, let's walk through a recovery scenario then. Okay,
let's do that.
The bonds are trading under 30 cents on the dollar. Let's say there is a full-on rescue. The bonds go from 30 cents to 100 cents. Okay, the equity may also triple, but I promise you, the risk is far reduced in the bonds versus the equity, which would triple from this price.
Sure.
Again, it's about putting your money where the best, the highest return for the lowest risk takes place. Yeah. And that's what you got to understand. And by the way, having traded enough distressed debt in my life, when debt trades at 25 cents on the dollar, it's about a 1 in 100 chance it goes back to 100 cents on the dollar. Okay. It just doesn't happen on a regular basis. And here's the kicker for me. How does the court system work in China again? What is the restructuring process in Chinese court look like? Damn, I don't know. And I wouldn't even want to find out. So remember,
it looks like whatever they want it to look like, I guess. We did see, though, which was very interesting, when GM went bankrupt, that the government did basically stick the shaft to some of the bondholders to get some of the money.
Okay, that's fine. Okay, that there was enough return. Like, they didn't get 100 cents back on the dollar, but the people that got in at the right price on the bonds did make a return. And those are the guys that drive a restructuring process. Generally, what happens is the big buyers of debt at distress levels run the restructuring process. Now, this was a government-sponsored TARP and all this stuff. Look, the world was ending. I don't even want to talk about GM because that was a manufactured government solution. Let's just talk about regular restructurings that occur without the evil hand of the government overhanging this. I've been through a lot of them. You need to understand that new money that gets into these plays aren't buying the bonds again so that they can go from 30 cents on the dollar up to 100 cents on the dollar. They're buying them so they go from 30 to 45 or 30 to 40, and therein is their return. Okay, mm-hmm. They're big distressed buyers. The Howard Marks group, Oak Tree, and all these beautiful, smart institutions that are so important for the efficient functioning of capital markets and the creative destruction aspect of capitalism. That's been largely removed lately because the government comes in and says, I'm going to backstop high yield bonds and I'm going to do this. And it just removes the efficient market pricing mechanism, which penalizes people that take too much risk. Well, some people who take too much risk take out too much debt. Yeah, that's a fact of the equation. Now, Evergrande, I call it Evergrande. I'm not sure if it's Evergrande or Evergrande. It's a dog's breakfast run in a country where you have no idea what the court system is like. Right. These distressed funds are absolutely very at home in the courts. They understand the judicial system in Canada and the United States, but I'm not sure they really understand the judicial system in China. And I wouldn't want to be that guy, okay, that goes and trusts.
Yeah.
I just wanted to take a second to explain to you one more time just how cool having this new BlockFi Visa credit card is. I've started to move a lot of my bills over to get paid from this. Of course, all my business supplies, I'm starting to pay for this, my advertising budgets, and I'm starting to run as much as I can through it because I'm getting paid a percentage back of every single transaction in Bitcoin. We want to save in Bitcoin because Bitcoin is an asset that goes up in value because of the deflationary nature of it. And we want to spend our fiat. So I'm spending my fiat through my BlockFi Visa card, and I'm getting back Bitcoin that I can save and I can hold. I expect it to go up in value a lot. I expect to hold my Bitcoin. I'm going to pass it to my kids and my grandkids, and hopefully my great grandkids will have my Bitcoin one day. So I'm going to save it. I'm going to spend my fiat through this card, and I'm going to earn back Bitcoin that I'm going to save. If you want to get one, there's a link down below.
I want to jump into the CDS, into some more credit for default swaps, but just real quickly, what do you think the contagion is potentially?
So good. You never know, but I'm going to borrow Jeff Booth, a fellow Canadian and a great friend of mine. he had a great quote the other day. He goes, "You never know which snowflake causes the avalanche, right?" And this Evergrande situation, if you look at it relative to the U.S. subprime, it sounds like it's massive, right? That being said, first of all, the U.S. subprime was contagion across not just the real estate industry. Where the U.S. subprime really hammered the financial institutions is that the Lehman's and the Bear Stearns of the world were sitting on residual risk of structures that they had manufactured out of the subprime mortgage fiasco. They were holding the bottom tranches of the risk pool. And when those bottom tranches of the risk pool rightly went to be valued at zero, the Lehman's and the Bear Stearns were losing their risk absorbing equity because they had to write it off against something. Right. And the market realized, oh boy, if I write off the Lehman Brothers losses, the book value of equity of Lehman Brothers goes to zero.
Right.
Bear Stearns was in the same situation. And the funny thing is, Kramer was on the show and he's like, "You have no idea. The Fed has no idea." And then the Fed came in and reduced rates, and the equity guys thought, okay, it's all good. The Fed reduced rates. But then Bear Stearns stock started going from 120 down to 85. And guess what? JP Morgan bought Bear Stearns for $2 a share. The real value to JP Morgan was probably minus $50 a share. But the Fed orchestrated that buyout because they couldn't afford to have a Lehman and a Bear Stearns fail at the same time.
Yeah, picking winners and losers.
Well, that's unfortunate. One of the reasons they say that happened is because the CEO of Lehman Brothers in 1988 was one of the only CEOs to oppose the long-term capital management buyout. This is, look, I'm a conspiracy theory guy, but this holds water to me. He opposed the long-term capital management buyout orchestrated by the Fed. And this was his payback. They'll rescue everybody but him. Wow. Yeah. If that's the truth, what is fair about that process? And is socializing losses for your buddies or crony capitalism, is that fair? Again, the Fiat Ponzi, the centralized Fiat Ponzi. Okay. You got to insure yourself against that.
Yeah. Yeah, no, it's the furthest thing from fair, right? When somebody can control it, when somebody can choose and pick winners, losers. It's the furthest thing from fair, especially like you said, socializing losses. So I want to pull this up. This is what you and I were looking at before, which is this El Salvador 5-year credit default swap, CDS credit default swap premium. Yeah. And so it looks like from 2015 to 2019-ish, it kind of stayed kind of somewhat
stable.
Stable, I suppose. I mean, you can see there early 2020 really.
Well, that's COVID down. Right there. That's COVID, and that the whole world. If you actually pulled up this credit, so what this means, let's tell your listeners what that means. That's 400 basis points or 4%. Okay. What that means is on a $10 million exposure, you would have to pay $400,000 per year to insure $10 million of El Salvador debt. And you'll see in 2020, at the beginning of 2020, when COVID hit, that rate jumped to 1,000 basis points or 10%, which means you had to pay $1 million a year to insure $10 million of debt against default.
Okay.
That insurance premium effectively increased, meaning the owner of insurance at the beginning of 2020 saw his contract increase in price meaningfully. I could back out how much the price increased if you want me to do some bond math for you, but I don't think I don't want to lose people. I'll just tell you that think of this premium or the insurance industry on your house as saying, well, the chance of a house fire in the valleys of LA is very low or lowish, and it's historic. Oh my God, there's a wildfire coming. This is now how much it's going to cost to insure your house in LA Valley. Okay. Much like that, there's an insurance market on El Salvador. So this market, but if you overlaid the CDS chart of any other risky country, you would have seen the same spike in yield in premiums and the corresponding spike in rates in their treasury market because of credit due to the increased COVID risk throughout the world. But then you see it starting to decline, okay? As the rest of the world did. The Fed came in and rescued the world. They said they would buy back high yield bonds. So the same chart would be visible for any high yield bond borrower.
Okay.
The risk essentially gets taken out of the market because the Fed backstops it. The key thing to remember there, and I think this is where you were going with this, is they did spike again because they announced their Bitcoin intentions. In the short term, if you go back to that chart, you'll see around June, in that chart, that the thing did spike again.
Yep. Right
in June, right here, right, go up about, go to June 2021. That spike was because they announced Bitcoin. And then the market just said, you know what? Actually, Bitcoin could be a very good thing for these guys.
Yeah.
So that's what I read from that chart. Now, having not traded a CDS contract on El Salvador ever in my life, I might be missing some of the intricacies of the particular credit of El Salvador, but I don't think I am, because I can look at a CDS chart and I can overlay any other CDS or credit borrower. And that's where contagion comes in, because let's just play a game here. So you're a big fund and you are playing in the credit default swap market, buying and selling insurance. You're essentially an insurance provider. And you need to hedge yourself. And you're like, okay, I play in this risky market and I have sold insurance on El Salvador. Okay, what does it mean when you sell insurance? It's the same thing as buying a bond. You have given your risk to the borrower. So you've sold insurance on El Salvador and you're like, damn, maybe I made a mistake. How am I going to hedge myself? And I don't actually have the opportunity to go out and sell and purchase that insurance or off that insurance risk to someone else. Maybe I'll go out, Mark, and I'll buy insurance on Panama. Right? You've sold insurance on this country, you buy insurance on this company, and you play the spread between the premiums of the two markets. The hedge funds do this all the time, but that does lead to contagion.
Yeah.
Walking it back to the Bear Stearns and Lehman Brothers examples. Imagine if you had sold insurance on Lehman Brothers. When you sold insurance and Lehman Brothers is going to, the market's telling you it's going to default, you're way in the hole. Like your insurance contract that you sold, someone's like, thank God I bought insurance from Foss.
Right.
Let's assume I had no counterparty risk. Well, Foss is not happy. So Foss has to go out and hedge his own risk. So what does he do? He goes and buys insurance on Goldman Sachs.
Right.
He buys insurance because he had sold insurance on Lehman, and then Foss tries to play that spread. Well, that's all hedge funds do all day long. Okay. And it's very efficient and it's very deadly. And you're dealing with tens and hundreds of millions of dollars, not these little penny stocks that trade and people think they actually have any value at all. I promise you, when the CDS markets of the countries explode, you don't even look at the equity markets. They know nothing. And Jim Cramer said that pretty accurately. They know nothing. All right. Remember this. Everything happens in the credit markets. The equity markets, once again, are the rag doll that gets flung around by the equity market, by the credit markets.
So if the the bond markets are the dog. And
they are. The bond markets are the dog.
The equity markets are the tail getting wagged by the dog. So the stocks are just helpless against what the bonds are doing.
100%. You see it every single time because traders will run to hedge their positions in the equity market. And they don't actually have to sell the particular equity. They can just purchase insurance on a basket of equities, which basically is buying options. And when they are buying options, they are buying volatility. And as you know, when volatility expands because there's more buyers than sellers, volatility is a leading indicator of falling equity prices.
So the equity is getting wagged by the bonds. And then I'm just curious, then if I was going to focus on the bonds, then am I actually watching the CDS market?
You should, because it removes all other players. It removes the elephants in the room, which are the central bankers that are trying to artificially manipulate the cash price of those bonds. And that's the key. You need to understand this. A bond will always trade for a price. Okay.
And that's because, like in the United States, I believe the Fed is buying about 85% of all bond issuance right now.
Yeah. So they're an elephant in the room. But so they cannot.
They're artificially pushing the price
suppressing
down.
10 years rates. Correct.
So there's no price discovery there. But if we look at the CDS market,
bingo, buddy. Why don't you open a hedge fund? By the way, no, don't. Just stay in Bitcoin, because it's the best asymmetric trade I've ever seen in my life, and it actually is the equivalent of owning insurance on fiat bond collapse. So I think of Bitcoin as being insurance on a basket of fiat currencies, which are prone to default.
Yeah, I want to find out. I want you to walk us through that real quick, because I know you have some calculation. Before we do, I just want to say something that there's a lot of stuff. There's a lot of information, and probably went over a lot of people's head. I was trying to help digest this, but what I hope everybody's hearing is that the bond market, these credit markets, are where the big boys play. It's where all the big money is. It's where everybody's attached. That's what created the 2008 financial crash. And we can see another storm is brewing here. Like
I believe it is
not smooth sailing ahead. What I would like for you to do is to synthesize this data and just tell me what we're expecting over the next couple of years. But I'm not going to have you do that right now, because I want to announce to everybody that we are having a live event. And it is coming up in a couple of months, and Greg is going to come and he's going to tell us that answer. So,
so this is beautiful, and I appreciate I did commit to going. That's absolutely fantastic. I do have a paper, right, that I've published, and anybody can read it. That details, and it's a 50-page paper, ladies and gentlemen. I cannot synthesize this too much, because, by the way, it took me 30 years to learn this, right? Yeah. It's not like you go in and you say, oh, okay, now I'm a professional credit trader. No. So yes, I'm looking forward to that event, but I also can provide a paper that will, goes into detail about this analysis. It's a 50-pager. It's gotten some pretty good reviews, because people go, oh my God, I had no idea.
Okay, well, don't spoil it. Don't spoil it.
I won't.
But we're having a live event, and it's really focused on just how to survive these next several years. There's a lot of turmoil, the Great Reset. By 2030, you'll own nothing and whatnot. And the way these markets are crashing could be one of those ways they get those assets from you, real estate, et cetera. And so I'm hoping that you'll synthesize some of that data and tell us what you think is going to happen. Not teach us how to be bond trading masters.
Okay.
But anyway, I just want to throw that out there. We're going to put a link in the show notes down below if you want more info to come hang out with me and Greg. With that being said, with that little plug, going back to what you were just talking about, let's just run through that. So Bitcoin, obviously.
Yes. Yeah.
You have some math as to where you think Bitcoin could go based off of the size of the bond market and where you think that could kind of suck that world in. Is that right?
Yeah, I do. And it's included in the paper, and I don't know if you want to share it with your readers or not, but they can find it on the internet somewhere, because it's been published and a lot of people have read it.
Yeah, we'll link it down below.
Okay. Well. I appreciate that. Here's what I know for sure. Okay. Before I go into the math, let me tell you what I think the next 3 years holds. Okay. Very simply, look, any of these crises is normally accompanied by a leverage unwind, which means, let's say you are running a hedge fund and you're using leverage for your unit holders. And all of a sudden your unit holders are getting nervous and they want cash. Well, you get a collateral call, or a capital call from your unit holders, and you're a hedge fund guy, you have to sell stuff. There's no other way to deliver cash. You don't deliver units. You don't deliver a promissory note. You actually have to deliver cash, which means you have to sell stuff or unwind a trade. Right. And these leverage unwinds are the painful byproduct of a loss of confidence in the system, right? So the Fed will do everything it can do within its power to eliminate another leverage unwind. What does that mean to a guy like me? It means that any talk of a Fed taper in the next 3 years is a pipe dream, right? Especially with stuff like Evergrande going on, because that's a systematic risk to the confidence.
Right.
It's a systemic risk. And all that systemic risks are is a loss in confidence of the leverage in the financial system.
Right.
Very simple. So the Fed will do everything they can to increase that confidence or maintain that confidence, which means, in my opinion, it's an impossibility that they taper in the next 3 years. And by the way, it's also mathematically certain that they don't taper in the next 3 years.
Would you say would you say any meaningful taper or any taper?
I'll go out on a limb and say they can pretend that they're going to taper, but when they stop pretending to pretend, the market's even going to call their bluff. Okay.
Well, we saw them go from we're not thinking about to then they said we're thinking about maybe in a couple of years.
That's fair. What are they still doing? What are they still doing? They're still purchasing 80 billion a month. Okay. Let's see that number go down like they tried to walk it down after the great financial crisis. Yeah. And the markets gurgled and the equity markets didn't like it. They had acid reflux. And I fully anticipate the Fed knows that they'll have a worse acid reflux this time because there's more risk in the system. And so there's a great quote that I've lived by for 30 years. Okay. When the perception of risk is low, as it is now, actual risk is high. Things like people say, oh, nothing bad can happen now. Well, they always do, don't they? Mm-hmm. Like, things are smooth sailing. Yeah. So, then you get an event like an Evergrande that causes people to lose confidence. And then the flip side to that is when perceived risk is high, like the world is ending, actual risk is pretty low because, you play that devil's advocate. You say, well, if I buy something here and the world ends, well, it doesn't really matter anyway, because the world is ended. But if I buy stuff here at such distressed prices that there's a good chance that you'll make money by buying something at those distressed prices, then actual risk is low. So again, when perceived risk is high, actual risk is low. And when perceived risk is low, actual risk is high. Well, right now in the market, notwithstanding the Evergrande situation, perceived risk is low. Insurance is cheap. Well, when insurance is cheap, you're supposed to buy it. And in my opinion, Bitcoin is insurance against default of fiat countries and central bank shenanigans in general. So how do I get to a value of Bitcoin using the global financial system? It's quite simple. Total global financial assets in the world today equal US $900 trillion. Okay, that includes real estate, it includes bonds, it includes bank debt, it includes equities, commodities, gold, fine art, currencies. I've always forget one or two, it doesn't matter. US dollar 900 trillion worth of global financial assets. I think that there's a chance, since I'm an engineer.
That doesn't include the derivatives markets?
No, it does not.
Because that's another quadrillion.
But it doesn't matter. Derivatives largely net out, meaning for every guy that's long, that's long a derivative, someone else has shorted it.
Okay.
So the only real thing you have in the derivatives markets is some residual counterparty risk, and it's when those counterparties start failing that you realize, oh, don't worry, I bought insurance from AIG. You're Goldman Sachs. Remember, why didn't AIG fail? Why wouldn't the government have let AIG fail? Because it would have meant if they let AIG fail, Goldman Sachs would have failed as well, because Goldman had purchased so much insurance from AIG.
Right.
And if that insurance company was that insurance contract was now one-sided, where Goldman thought they had purchased the insurance and laid off their risk, and all of a sudden they didn't, Goldman was gone too, right?
Yeah.
So let's just look at the cash markets for
900 trillion.
And then I need to make a caveat that I think, as an engineer, that Bitcoin, which I view as digital energy, will someday soon will be used in the global energy markets to price oil and natural gas. I think Vlad Putin doesn't really want to get US dollars and US treasuries for his valuable natural resources. And he would rather get digital energy because for his natural resource energy. And nonetheless, if it's not him, some smart country is going to start doing this. I actually hope it's Canada. because we have a lot of natural resources in Canada.
I'd say Putin probably be on it before Canada.
Oh yeah, well, Putin's way smarter than Canada. That's no question. Yeah. And so anyway, if that happens, and I actually believe there's a high probability it will, and the petrodollar will be at risk. Don't you think that there's a chance that Bitcoin could capture, let's say, 5% of global financial assets? I'm not saying it's going to be your global reserve currency, but I say it would be on its way to being a global reserve asset. Do you think it's reasonable to think that you could get a 5% market share? I'd be like, wow, 5%, that's way low. But let's just play the game. What would Bitcoin be worth if they captured 5% of $900 trillion? Well, 5% times 900 trillion is $45 trillion. What's 45 trillion divided by 21 million Bitcoin? Over $2 million a Bitcoin, Mark. Yeah. 2 million. And that's at a 5% likelihood.
Right.
I'll take that bet. I like that. And I can back out a probability from the current market price of Bitcoin as to what the odds the market are giving me. And the odds the market is giving me, I won't confuse you with the math. They're basically saying, Foss, there is less than a 2.5% chance that Bitcoin goes to your price target. And there's a 97.5% chance it goes to zero. And I'm like, well, your odds are way low. I think the odds are far higher than that. So I'm a buyer at the current price of Bitcoin.
Right.
And I've always managed risk that way. And it sort of served me well. One other thing I don't ever do is I don't ever stick to a trade if I realize I've made a mistake in my calculations or the information has changed.
Sure.
I get out of that dang trade.
Sure.
I am not a conflicted, stupid person who wants to get carted off the trading floor. There's plenty of those people out there.
Yeah.
They may have done the math, but they won't endorse Bitcoin because it goes against, let's say, they're a gold fund manager. So, I don't want Bitcoin to succeed because
I heard that debate. It was
it wasn't a great debate, but at the end of the day, what I did try and point out is that Peter, who I do have respect for, but look, at the end of the day, I will never debate those types of people again. He has been a horrible risk manager. I'm afraid he has. Look, if you are 99% of the way there and you don't take that last little, you fumble the ball on the 1 yard line when Bitcoin was at $10.
Yeah.
And then you continue to admit that no, I never fumbled the ball. No, God promised you it's going to zero. Like, dude, that's just absolute horrible risk management. And anyone who entrusts him with their money, I don't think they're getting their management fee worth, because somebody who is that close to diving into the end zone and then fumbles the ball and insists he didn't fumble the ball, I wouldn't give him money.
So how did you come to the math that the market's given a 2% chance of getting to that number?
Okay, so it's pretty easy. It's a probability analysis using expected values, right? If you remember your statistics, what you do is you take a probability times a price and you do a calculation. Now, normally an expected value calculation, probability times price versus all the expected values. And normally in a bell curve, it's what's called a continuous distribution. But in this one, I'm just going to use a binary distribution where there's only two outcomes. One, my 2.5 or my $2 million price target or higher, and one where the price is zero. So it's called binary because it's not continuous in between. Okay. I'm just using those two. And I'm going to say, okay, the current price of Bitcoin is $50,000, just to make the math easy. Or let's say, what is it? 45. I'll do the math on the fly here. I haven't even looked at the price of Bitcoin today. I'm assuming it's 45,000 US. Okay.
It's actually 47.5, but whatever.
Well, now it's really going to make it difficult. How about we use 50,000 just to make me not look too stupid without a calculator in my hand? If $50,000 is the current trading price, and there's only two outcomes in my binary distribution, there's zero and there's 2 million. Okay. At $2 million, you need to find a probability that 50,000 reflects $2 million versus the other side where zero fills in the distribution. And, I'm not explaining it that well, but basically you take 2.5% times 2 million, right, is 50,000. So that's how much the market is telling you the chance of it going to $2 million is. It's only 2.5%, because 2.5% of 2 million is 50,000, right, Mark?
Okay.
You do the math. You can take out a calculator right now. I'm almost certain I'm right. Actually, I know I'm right. 2.5% times 2 million is $50,000, which means since there's only two outcomes, the market is telling you there's a 97.5% chance it goes to zero. Dang. First of all, I don't think there's any chance it ever goes to zero. But at that point, I'm just like, this is as simple as Foss can get. And Foss doesn't have a big brain. He likes to trade things, and he has to make his mind up on the fly. And I don't do it on the fly, but when I sat in a chair, I basically had to make these types of calculations all the time. I'm like, ship it in. Yeah. I'm a buyer. Now,
I've never been a big gambler, but a lot of my friends would bet on every sport.
They would know this then. They would know
that would ever happen, right? And so then the bookie would give them the odds on a game, right? And this team's going to win by this many points. And they're like, no way, I'll take those odds, right?
Okay, same thing I'm doing.
Yeah.
And how about this? It's even more simple. Let's say you've trained a horse, okay? And you have not inside information, it's just you're more familiar with this horse. And you go to the racetrack, or you've seen this horse training. Let's just say you don't have any insight, but you're like, I've watched him run laps, and this horse at the racetrack is being given 100-to-1 odds of winning. And you're like, man, this guy's a lot better than 100-to-1 odds. What do? You go to the ticket window and you're like, oh, I'm going to put $1,000 on, Moss Foss, and Moss Foss is going to win this. And 100-to-1 is a wicked good payout, because really the odds, maybe Moss and Foss were saying, you know what, the odds of our horse winning is probably much closer to like 4-to-1.
Right.
Well, someone's giving you 100-to-1 odds. Mark, what are we supposed to do as the Oz brothers? We go in and we purchase that ticket.
You got to take it. And I think the one thing that you're talking about too, I mean, using gambling as another analogy, it's about having that discipline and that strategy that pays off over time, right? So like eventually when you play the odds properly, then you win.
Oh yeah. Look, I'm not telling you that I'm certain that Bitcoin's going to $2 million.
Right.
What I'm telling you is the market is only saying there's a 2.5% chance it's going there. And I'm thinking like there's a 25% chance it's going there. Now, backing that out, let's play another game. What should the price of Bitcoin be today if the market told me that there was a 25% chance it goes to $2 million? The answer is $500,000.
Right.
So basically, I'm buying something for $50,000 that I think should be trading at $500,000.
Because you think it has about a 25% probability of getting to that.
Exactly.
Got
Is that fair? And it's nothing more than going to the track, and the bookies are doing this on Dallas versus Baltimore or whatever. No different. They lay the odds. They make their vig. Over time, they make money on the spread, buying and selling things, trading off that risk. But you and I, what we do is we try and trust our guts and probability analysis. Doesn't mean we're 100% certain. This is what I need to tell Peter Schiff all the time. Yeah, I'll accept that there's a high probability that Bitcoin goes to zero or in lower price. But I also think it's the best asymmetric trade I've ever seen in my life.
And that right there is what I talk about, the asymmetric trade. So I actually have just a Bitcoin only newsletter that goes out, and I call it the Asymmetric Edge.
Attaboy.
And because to get the asymmetric play, as you're saying, you need to have asymmetric information. You need to have watched the horse train.
Okay.
And if you have the asymmetric information, then you get the asymmetric gain. So that's why I call it the asymmetric edge. Like as long as you're keeping up with what's going on with Bitcoin, if you're watching that horse train, then you have better than average odds. You've studied a lot, which is why you get a 25% probability. When the market, which is the writing the most absurd news in the world about it, obviously knows nothing, which is why they're giving it 2.5%.
Correct, essentially. And take it one step further. I can't say this strongly enough after 30 years of trading risk. Asymmetric trade opportunities define careers. The markets don't offer this up very often. The markets are much more efficient than this in general.
Right.
But for an asset that's only been around for 12 years called Bitcoin, it's not surprising that there's so much old money stupidity that still hasn't embraced it.
Right.
And all I can say again is asymmetric trade opportunities define careers. My asymmetric trade opportunity in my career occurred after the great financial crisis, when I was able to buy restructured asset-backed commercial paper in Canada at between 25 cents and 50 cents on the dollar. I was able to buy literally billions of dollars of this, and we got paid our 100 cents on the dollar back. Okay. And it defined my career. And at the time, I'm like, okay, I've found my defining trade of my career. It's time to hang them up. And I tried to hang them up, and someone introduced me to Bitcoin. And I'm like, this trade is 10 times better than the best trade I'd ever executed in my life.
Yeah.
And I'm like, by the way, look, I'm privileged. I worked hard to get privileged. I'm doing this not because, well, let's be honest. Look, I'm in a position where if Bitcoin goes where I think it's going to go, then I'll be happy, because but maybe I'll donate most of that money. Not that I'm a philanthropist, but what I will say is I need other people who are not in a situation like I am to benefit from some of my experience. It makes sense that you take these asymmetric trades and you build a portfolio that, I'm not saying put all your money in it, right, but if you own 0 Bitcoin, you're actually at higher risk than someone who owns, let's say, 5 to 10% of their net worth in Bitcoin.
Right.
And that's the key, Mark, because it's my kids that are at risk from these politicians that have pulled forward gains that my kids should be able to live. They pulled them forward for my generation of selfish boomers who are too soft to actually, pay the piper in the present. They want to, Andrea, what her name is, AOC, whatever her name is, we'll just print more money and we're going to tax the rich. And it's disgraceful. It's intellectually laziness. Some of it's purely conflicted, old Munger there, Charlie Munger. First of all, who talks to a 94-year-old man about technology? And secondly, do you think he would actually want Bitcoin to succeed based on all his exposure to the financial players that Bitcoin will disintermediate? Right. Charlie Munger, with all due respect, go fuck yourself. Okay. You are giving very poor advice to my children. And for that, I will never forgive you. You're a conflicted old fuck. Okay. And do not do this because it's criminal behavior.
Yeah. Yeah.
You can edit that out if you want. If you don't want, I'm happy that goes wide on the internet. Okay. I'm disgusted with people like him who are so conflicted, who are either intellectually lazy, at which point you don't want him to manage your money, or if he's conflicted, well, that's very dangerous.
Well, I think anybody that would go get their advice on technology from Charlie Munger probably deserves the advice they get. I wouldn't go ask him what app I should use or what VPN I would use on my computer either. And if I was asking for that advice and he gave it to me, then
to call it rat poison squared without doing the deep dive on it. Yeah. Again, you're costing people who believe in the Berkshire Hathaway once a year. Listen to these two gurus talk.
Yeah,
that's just wrong.
Yeah, no, I agree. I couldn't agree more. But man, we went long. We covered a lot of things. I loved your lesson that you gave us there at the end. Just kind of going through that kind of risk management and how you kind of evaluate that. I think that was helpful for everybody. So I appreciate that. I'm going to make sure to link obviously your Twitter, which you're super active on, down below. We'll link that paper. And of course, we're going to link the event for the live event if you want to come hang out with us.
And when is it again, Mark? The live event?
November 12 to 14.
I can't wait.
Yeah. And we're going to have, I got Brent Johnson coming out.
Oh, I love him.
I got Robert Breedlove coming out. I got
Come on. Nice.
Stephen Van Meter coming out.
All right. Well, I'm proud or privileged, or what should I say? I'm honored to be within that group of very deep thinkers.
We got currency guys, we got bond guys, we got gold guys, we got Bitcoin guys.
Okay.
And so it's going to be an amazing talk, and hopefully we're going to help people make sense of what's coming out in the next couple of years. So with that, we'll go ahead and sign it off. Greg, thanks so much for joining me today. All right, hey, I hope you enjoyed that interview I did with Greg. And as we've kind of teased it up, there is more to come. I'm going to have him distill this information and tell us exactly where he thinks things are going over the next couple of years, and more importantly, what we should be doing to navigate through that. So click on the link down below to check out more about the live event, and I hope to see you there.